So thank everyone for joining us. This is a repeat session of what we offered last month, but this is one of those things that's very important. I think that people need to know about this. We're going to talk about how people that own childcare facilities can maximize their savings by using some of the strategies that are not that well known. And so we're just going to jump into this. Things we're going to cover today, number one, is talking about what cost segregation is and what accelerated depreciation is, because those are things that are related. We're also going to talk about bonus depreciation, because that's something that if you don't know what the first two items are, you don't know what the third item is. And so we're going to define all that for you so you understand it, and then show you an example of what this can mean for your cash flow, which is going to be significant. And Dan's on the call too. We're going to introduce ourselves in a second, but he's going to cover some benefits of childcare owners, of the childcare facility owners, and how you can use these methods to actually improve your processes. And then we're going to talk about some of the unique physical characteristics of childcare centers. And then we'll talk about making up for missed opportunities. If this is the first you're hearing about cost segregation and bonus depreciation, it's not too late. And we're going to talk about how we can help you implement this, even though you've owned your property for a couple of years. So Dan, why don't you go ahead and tell the people about yourself?
Sure. So I started my career in education and worked in nonprofits for about 10 years and really loved that and got a doctorate in education. Still am committed to education and helping kids learn. And so I do a lot of that now in my kind of my free time, more as volunteering and still a big part of my life. So transitioned into a consulting role with CSSI after 10 years working in schools, and it was a really good fit. I had initially thought I was going to be a superintendent and got into a role kind of like that, but found out pretty quickly that superintendents get all of the hate mail, and then they get run out of town after a couple of years. And so I said, why don't I just go to the sales and consulting job now rather than wait a couple of years and a few more gray hairs after that. So I've been working at CSSI and with Tom for a little over 3 years now. And again, as Tom said, we specialize in helping building owners maximize deductions. And so to get to make people's day that way is really fun.
Great, thank you. And so my name's Tom Brody. I've been with CSSI about 5 years now. It's one of those things where I started off my career working for Shell Oil and then worked in the scuba retailing for a while, and then found cost segregation as a way just to bring additional value to people that in areas that they never heard of before. So that's one of those things that we love, really unlocking things that people didn't know about and giving them access to dollars that they didn't know that they had access to. So first, we're going to talk about what cost segregation is, and it's really about looking at buildings differently. Um, there's basically two different types of building lives when you talk about commercial buildings. You've got a 39-year building life, and that covers like offices, hotels, retail strip centers. Airbnbs, oddly enough, is really classified as a hotel. So that's really in that 39-year category. And then the other category is residential properties like single family rent homes or apartment complexes, multifamily. It's 27 and a half years. The way these have been depreciated in the past is that they put all these costs into what we call a bucket. CSSI uses this bucket analogy because it's a little bit easier to understand. So you've either got a 39-year bucket or a 27 and a half year bucket. And what would happen is that all those costs go into that bucket, and then it gets divided by the number of years of the asset's life. So you take $1 million property divided by 39, and that's the amount of depreciation that you would write off every year. And what cost segregation does is it breaks it out and realizes that there's other buckets available. So we're going to break it out into the correct buckets, and that bucket talks about the economic life. So you've got tangible personal property like cabinets, countertops, special electrical, QIP, which is qualified improvement property. It used to be called leasehold improvements. Those are things like sheetrock, interior renovations. Land improvements are the things outside the building itself. So you see all of these other categories have a different economic life. And so once these things are broken out into their unique economic life, then you can apply some of the tax laws, and namely the one that we're going to talk about today is bonus depreciation, which means all of these things in this green box can now be written off at a higher percentage, rather than breaking them out over 27 or 39-year life. So let's look at a real quick example of a daycare facility, right? This is a facility that was actually in my area, in the Houston area, 10,000 square feet. The building cost was $5.4 million, purchased in December of 2024. And in 2024, they would have written off about $5,700. Did the cost seg study, there's still a lot that's in that building structure category. So it's a 39-year category, but there's a lot of money that really gets associated with the tangible personal property and the land improvements. So if you're looking at that in combination of those two things, applying bonus depreciation, which means you now have a $1.4 million depreciation deduction versus that 5,700. So that's a huge benefit to cash flow, and that's something that the building owner can recognize the first year after we do the study. So this is what when we're talking about accelerated versus straight line, this is if you visualize it, this is what this looks like. So the kind of the orange line is straight line, which means it's the same amount of depreciation every year. And the blue line is the accelerated. So the reason it's stair-stepped like that is it's based on the economic life. So that highest stair step is all of the 5 year, the first 5 years of the 15-year assets, and then the first 5 years of the 39-year assets, all to add it together. That's why it's so much higher early on. And then it stair steps down once the 5 years have been depreciated, and then you just have the remainder of the 15-year and then the 39-year associated with that as well. Once the 5 and the 15-year assets have been depreciated, then you just have the 39-year assets that you would continue to depreciate for the life of the property. So that's really the difference between just straight accelerated and straight line. Now, if you look at bonus, you see the green line goes way up, and that's because you've got all of the 5 year, all of the 15-year, and the first year of the 39-year asset all written off in the first year, which is that's a huge benefit, right? You can see that. Now, one question that always comes up is, well, what if I've been on this property for a while? What happens then if I want to claim bonus? You've got the blue line is the straight line, and then the orange line is the bonus, and you see it really kicks in after, the first 4 years of assets. That's when they actually found out about bonus depreciation and wrote it off. So you have that big depreciation deduction early on, and then it drops down to be very similar to straight line. It's a little bit less because you've taken so much of it in that first year after you recognize bonus, but it's not zero. And a lot of people think, well, if I'm doing accelerated, I'll have no depreciation expenses out in the later years that I've owned the property. And you can see from this chart, that's not exactly the case. You will have a big write-off early on, but you're still going to have that write-off going off into the future that you own the property. Now I'm going to turn it over to Dan to talk about what are some of the other benefits to owners of childcare centers.
Thanks so much, Tom. Great job kind of painting the picture of what cost segregation is and how it works. So I'll ask the question that might be in your mind, and it's the so what question, right? Why should I care? And so the big one here is you pay less in taxes. You don't just pay less in taxes, you owe less in taxes. Sometimes I like to joke, anybody can pay less in taxes. We help people owe less. And so the another way to think about this is the time value of money. If I could give you $1 today rather than $1 39 years from now, it's worth more today because you can put it to work in your business. And so this is going to reduce your taxable income. And so you're going to have more money up front that you can reinvest in your business. So if you want to improve your property, if you want to maybe make it a little bit nicer so you can increase the fees, or if you're thinking about adding an additional property, we work with clients who, if they do a cost segregation on 2 properties, that frees up enough capital that they can then acquire a third property. So really, this frees up and increases cash flow in the short term so that you can put it back into your business and begin making money with that. The ideal time to do this is right when you purchase a building, the same year you acquired, or at least before you file your taxes for that year, and that just kind of makes it simpler to file it. And then even before you purchase a building, as Tom has here, you can include in the pro forma, meaning when you're doing the math of, okay, how well is this business going to do in terms of, all right, how much are you going to receive in fees for the childcare? What is your outflow? You can calculate this in as well because you're going to have just with even with our estimate, a very clear picture of how much you are going to owe in taxes, or rather how much you're not going to owe because of the increased deduction. So that's one of the additional benefits. And again, this increases cash flow up front so that in those riskier years when you might have more expenses or you're less profitable, you're able to stabilize, you're able to accelerate some of your plans for improving the business early on. And for most people, almost everybody we work with, that's a win. And again, this is based on the idea that money is worth more today than it is in 10, 20, 30, 39 years. If you plan to own your building for 39 years, then you might think, okay, how old are you going to be at that time? What are your interests going to be? And do you want the same dollar of depreciation 39 years from now as you get today? Or would you rather have that and then put it to work in your business? And almost everybody we speak with says, no, give me that dollar today. Um, Here are kind of some just comparisons, and this is really why early child care centers do so well with cost segregation. And it's because um, what drives the value of a cost segregation, there's two things. It's all of the components inside the property we would call finishings or that tangible personal property, and then everything outside the property. And I mean, as you see this, you'll probably start to think of your own buildings and all of the repetition. You have room after room with shelves and flooring and furniture and equipment and toys and you name it, all of which is specialized for your business. And so the more of those components that are in a property, the better a cost segregation is going to perform. And the idea here is the more you spend to get the property ready for the children to be there, for the teachers to be there, more and more of those components are eligible for faster depreciation. So you can get that deduction upfront and sooner if you want. And in almost every scenario, it financially makes sense, mathematically makes sense to get those deductions upfront and put that money to work. So even though you might have different layouts, the goal of the cost segregation is to go in and identify what's the total value of all those finishings on the inside of the property that allow you to get that bigger deduction. Um, and then kind of similar with the outside of the property. So think about the things that are unique to each location, the non-building components. So here, you can see, all right, the footprint and internal configurations of a center are similar. But our job is to go in and say, all right, what really stands out? What makes this property unique? And maybe how much more money in this particular property should be allocated to an area that you're then going to be allowed to deduct a whole lot faster. And so when I'm looking at this, you can see the parking lot, you can see the signage, you can see the decor, and especially this is a great example here. I'm going back to my school days, thinking about just the challenge and the logistics of doing drop off and pickup. And I mean, nowadays we're designing parking lots specifically for traffic flow. And so all of that concrete there that is, I mean, it's on the outside of the building. They had to pay for it. It's necessary to the business. That's going to increase the deduction on that property dramatically. And so if your property looks like this, or whether it has that much concrete or less or more in the playground, you name it, there's a ton of value there for increased deduction that an owner can benefit from. And then kind of a similar application here, right? Just think about the money that it costs to build that long driveway and to get everything ready to go onto the main road there. All of that, whether you built it or whether you bought it, those are additional costs or additional components of the property that can be accelerated. So you'll see they fall into that 15-year bucket, and any bucket that's less than 20 years is eligible for bonus depreciation, as Tom said. And what that means is rather than waiting 5 years or 15 years to get the value in those buckets, often you can get 100% of that right away. So if you heard some of the chatter around the big beautiful bill, what was reintroduced was 100% bonus. And again, that means all of the depreciation in the 5-year and the 15-year bucket can be deducted right away. And even if you don't use all of it, you can just carry it forward to subsequent years so that maybe you not just don't owe this year, but then the next year and the next year and the next year.
So thanks, Dan. So one of the questions that we always get asked is that, okay, well, what if I bought my building, my child care center several years ago? Is it too late to claim bonus? And the answer is no. Even if you've never claimed bonus or didn't even know what that was until recently, you may be eligible to claim it now. So what this is looking at is a chart of both the old law and the new law. So when this bonus depreciation first came out, it was set to 100%, which means everything less than 20 years, you could write off 100% of its value right away. And that was stipulated by years. And so from late 2017 to the end of 2022, the bonus rate was 100%. And when the law was originally passed, it was going to, that bonus rate was going to drop 20% a year until it went away. So based on the parameters of the law, it would have been gone in 2026. The one big beautiful bill came around and said, no, we're going to bring that back. So it started actually on January 20th of this year. That's when 100% bonus depreciation came back. So, and then the law said from this point on, 100% bonus is now the law of the land. So regardless of when you buy or when you built or buy something going into the future, it's still going to be eligible for 100% bonus. Now, the great thing about this is that if you haven't taken advantage of it, you can still do it. So let's say you bought a building in 2021. Well, that's in that first band of 100% bonus. So you could claim 100% bonus now. And what's going to happen, it's going to be the difference between what you've already recorded in depreciation and what you could have recorded at 100% bonus. And the great thing about that is that we can do this with the method. It's called a change of accounting form. And so that you don't have to amend the previous year's return to be able to capture that additional write-off, which is a huge thing. So let's talk about how we'd actually do that. This is a look back study that I was involved in on a car wash. This was a facility that was built in May of 2019, and they actually found out about bonus and wanted to pursue this. It was 2023, so it had been in operations for a couple of years. The 39-year building value on their depreciation schedule was 2.8 million, and the book depreciation that they had really taken up to that point was 192,000. Once we did the study and we realized there was $1.2 million in additional depreciation because they qualified for 100% bonus that they hadn't taken. And so we were able to get them that additional amount of depreciation expense, which dramatically reduced the taxes they owed. So you may ask, well, how do we do this? Well, we're going to look at the actual depreciation schedule, which is here. I know this is a little bit hard to read, but the one thing to notice is for the equipment, which is like $1 million, they had that properly categorized as a 7-year asset. But the building they still had down here as a 39-year asset. And that's that $2.8 million that we looked at to say we're going to identify that and break it out and be able to put it into as faster depreciating buckets, apply 100% bonus. And that's where we got the differential from $192,000 in depreciation deduction all the way up to 1.2 million. And this was money that they didn't know they had access to. So, no, we've been throwing a lot of stuff out at everyone, but I want to just let you know we can get started. It's very easy to get started with the estimate. And this is a no obligation estimate. We need to find out some information about your property so that we can compare it to other properties that we've already studied. And the things that we need are the construction or the purchase price, the month and year it was actually placed in service. That's when it was actually open for ready for business. Any renovations that you've added to the property since you've owned it, and then actually an address and a brief description. So with that information, we can usually turn an estimate around in about 2 business days. Right now, we're running probably maybe 3 business days because it's getting close to year end and everybody's wanting to get these in by year end. But those are things that we could actually give you the information you need to make a decision to find out whether this is something you want to pursue. Great way to do this, actually, I've got a QR code, and if you want to take a picture of that, this will take you to a landing page that will be able to collect information from you, and you can fill this out on your phone, and then we can move forward on getting an estimate. So you may ask, well, what's this process look like? So what I want to do is really talk about how this works. So the first stage is going to be creating the preliminary estimate. We gather that basic information we talked about. And when we give you the estimate, we're going to give you a range, a high to low range of what we think we can save you. And this is based on other buildings, just like yours that we've studied in the past. With the estimate, you'll get a quote of the study fee. So at that point, you look at it, see if it makes sense for your tax situation, share it with your CPA or tax preparer to see what they think because they know your position. Once you accept the estimate and want to go forward, we have you sign the engagement letter, pay half of the fee up front. That's a deposit. And then we'll ask for some of the details, like any drawings you have, the details of the investment that you put in as far as you added on any capital improvements. We like to see some invoices and things like that, just so that we've got the right documentation to prepare for the IRS. Then once we have that information from you, your involvement in the study really ends. And so we're going to go off and our team's going to be doing their work. Of course, if they have any questions, they'll come back and ask you. But once you've given us the information, you can sit back and concentrate on your business again, knowing that we're going to work on getting you the study. The study usually takes about 2 to 4 weeks after we have all the data from you. And then once that's finished, we're going to deliver all of the data to and your CPA, or just to you, depending on how you want to process that. And then at that point, we'll charge the balance of the study fee. So it's really simple. It's not something that's going to take a lot of your time, but the potential savings and the benefit to your business would be tremendously impactful. So I know we threw a lot of things out at you. Everyone's actually muted. So if you want to actually unmute yourself and ask a question, or you can throw something out in the chat. I don't see anybody has any questions in the chat right now. But we'll kind of stop here, and I'm going to actually show that that little QR code to go to the landing page, but we'll open it up for questions. Just remember to unmute yourself. I'll kind of answer my own question. One of the questions that we get a lot is, okay, how does this work? I've owned the building for a couple of years, and you're saying I can capture that. There's a form that the IRS uses. It's called the change of accounting form that says you're going to be changing from using straight line depreciation to accelerated. And what that means is it's actually going to calculate the difference between the depreciation you've taken and what you should have taken using accelerated. And we can actually help you prepare that form so that your CPA doesn't have to do it. And actually, there's not a CPA I've met yet that wants to do that form. It's a very involved form. It's like 25 pages long. We will actually prepare it, give it to your CPA in draft form. They can review it, sign it. Takes them a lot less time to do that. And we support all of our documentation. And so if you ever have any questions, come back to us, and then we'll be able to answer those things. So Pat, you've got your hand raised. Go ahead and unmute
Yes,
yourself.
sure. Can you hear me?
Yes, I can. Yes, we can.
Yeah, sure. The question is that so for the cost, I mean for that we're gonna do some type of this accelerate appreciation, right? It's gonna be, let's say if we acquire the property and the property already have the pavement, concrete pavement, but we didn't spend money to do it. We cannot claim for that, right?
So
Claiming for,
you would, Pat, in as much as
yeah.
what you're buying, like you're paying for all of the improvements. And so anything that you
Ah,
acquire, you get to
okay.
depreciate.
Okay, I see. So it doesn't mean that we need to spend money, but we already spend money to pay for that pavement already.
Yes.
Okay, got it. Thank you.
Yeah, so you've paid for their improvements. The other thing that people sometimes get confused on, if the building was in existed before, let's say it'd been around for 5 years, and you buy it, the depreciation clock starts over for you. So you're buying a 5-year-old asset, but your ownership starts with when you purchase it. So that's the depreciation clock starts over for you at that point.
Maybe another one more question, if
Sure.
it's okay. Yeah. Let's say if we have the restaurant, right, and then we just build it new from the at the strip mall from the shell building. So this can be applicable also, correct?
Yes, if you don't own the building, but you paid the build out, to
Uh-huh.
make that shell a
Uh-huh.
restaurant, absolutely,
Yes.
because you've had to put in the commercial kitchen and dining room and all those
Yes.
things.
Mm-hmm.
That's an investment that didn't used to be, but under the recent tax law changes, that's now a depreciable asset and can be accelerated.
Okay, sure. Thank you.
You're welcome.
There's a question in the chat, Tom, that I already answered from Tammy. So does any of this apply to in-home daycare businesses? And I answered her, but just for everybody else's knowledge, So yes, if you use a portion of your personal property for business, then the cost segregation would apply to that percentage that's owned for personal or that's used for business use. And so, I mean, let's say kind of an easy example here would be if you had a duplex and you lived in one side of the duplex, but you operated a childcare out of the other side, then half of that building would be eligible for cost segregation. So if you spent 500,000 to acquire that building, then $250,000 would be allocated towards the business use.
Yeah. Another way we've seen people do this is that they would buy a residence and convert the residence. So it was originally built as someone's living in it, but they've actually converted it completely for, say, a Montessori or some child care facility. I've even seen that for, assisted living homes, where it was originally built as a home, as a residence. Somebody else bought it and now they've converted it to commercial use. And so that's a cleaner way of doing it if you want to look at that. So all of the costs of that building would be applied for a cost segregation, not just part of your home that you still live in. Anybody else? This is open question time, so take advantage.
I'd say for both Tammy and Pat, I'd recommend using those links to submit the information on your properties, and that way Tom can create the estimate for you. It'll show you, all right, how much of a deduction are you looking at to see, okay, does the ROI make sense? And whether that's something you want to sit down and look at with Tom or with your tax professional, it's information that allows you to make a decision or information that helps you to make a decision that you might not otherwise have.
Yeah. Hey, John, I see your hands raised. Go ahead.
Yeah, so talk about the importance of acquisition value as it breaks down between land and structures and how that's a very important part of this process.
Absolutely. One of the things that when John's talking about when you buy a property, you're buying the land and the building. The land piece is not depreciable, so you can't depreciate land. So you have to subtract the land value out of that. Now, where this becomes really important is if someone overvalues the land and they put that on your books, that land piece, you're not going to be able to depreciate that. So you want to be very careful in how you value the land because you know, you're not going to put it in there for a dollar, but you want to make sure that you're not overvaluing it as well. So that's where it's really important to get a real estate professional to give you an estimate of what the land value is, because that's not something that we're going to be able to tell you. That's going to be up to you and your tax professional or your realtor to say what's the land value so you get the actual building value because that's what you can depreciate. And that's what we need to know is what is the building value so that we can depreciate the maximum amount of the building that you're eligible for. Great question, John. So is there anything else in the chat? I don't see anything.
Tammy, we'll probably have a couple follow-up questions for you just on some additional building details, but we'd want to allow you to answer that kind of more discreetly or directly with Tom via email. So we'll shoot you an email after this webinar and let you know what else we would need for that.
Okay. Well, I want to thank everyone for your time. And this was a great attendance. Like yesterday morning, there was like nobody signed up. And then we had over 23 people signed up within the last 24 hours, which was awesome. But if you have any questions or what I'm going to do is this is actually being recorded. And so I will send out the video recording to everyone that had registered. And so if you have somebody that missed it and wasn't able to register it, please share that with them or just share my contact information, which is on the screen, so we can get them involved in this process and at least up to speed so they know this is something that's available to them if they own a a child care center, even if it's another commercial property, it applies. This was just concentrating on child care centers because it's really an underserved community as far as knowing about this and being able to take advantage of it. So with that, we will sign off. Thank you again for attending and let me know how we can help.